on that and also the expectations for the share market open. Stan Shamu from IG joining us now from Melbourne. Stan, good to see you there. Yeah, just firstly to that record closing high on the S&P 500 above 2,000 points for the first time at the close. The European markets having their best gains in months as well. Just in terms of, I guess, what's driving it, I mean, there are low volumes we're hearing in the US. What's behind it, and is it going to continue?
Morning, Brad. Yeah, absolutely. It seems like equities are in a very good space at the moment, particularly in the Eurozone. Of course, just those comments from Mario Draghi over the weekend seem to have really ignited things for European markets. We've seen all those bond yields, particularly for the periphery, start to cool in a big way, and this has really encouraged some sort of buying. At the same time, the euro is actually dropping quite significantly as well. I think now it looks like it's firmly headed towards that 131 mark. So with that in mind, I think a lot of investors feel that there's a lot of value in European equities at the moment. There are cheap funds on the way as well, and of course with anticipation of some sort of QE going forward, then there's definitely room for further gains. I think as well the fact that we had already seen a pretty big pullback in European equities after they printed their record highs recently, particularly the DAX, which had rallied above that 10,000 mark and really pulled back nicely into value, probably in the mid 9,000 sort of level, and that's where a lot of money is looking to go at the moment. Of course, the German DAX is obviously the biggest economy over there and the biggest market, so I think naturally getting exposure to Germany in a situation where you expect cheap funds to come along and of course a weaker euro to be in play would probably be a logical step, particularly because it's such a big export-driven market as well. And I think on top of that, as long as we see the European markets trade at a discount to obviously their record levels, then I think a lot of investors will continue to see a lot of value there. And as well as long as we see bad data out of the Eurozone, it looks like it will be something that will encourage investors to continue getting back into that market. So any pullbacks at the moment, particularly in Europe, are probably going to be used as an opportunity to buy. We also have subsiding geopolitical risk. It seems like Ukraine and Russia are going to engage in some sort of talks. Perhaps it will yield something positive, but of course there's always that little bit of doubt. But for now, I think it's enough to appease investors. Just moving along to the US, of course, the S&P closed at that 2,000 mark for the first time ever. Of course, there were some very positive economic data prints, particularly those durable goods, which rallied, I think, 318% to a record level, although it was skewed because of some pretty good orders for commercial aircraft, particularly with that Boeing 787 being very popular with some of the biggest airlines out there. Then, of course, it does seem like the US continues to churn some positive data. The big surprise, though, for me was the fact that good data for the US economy translated to gains in equities as well. Perhaps that's why we didn't quite see very big gains in the S&P, for example, because of course at the moment the timetable for the Fed funds rate hike is very data dependent. So as long as we see very strong data, then naturally the market will start pricing in sooner than expected Fed funds rate hike. So that's probably the only surprise. But for now, I think investors are very, very excited about equities across the globe, just due to the fact that we might see stimulus from some of the biggest central banks.
Just onto the Aussie dollar, an interesting call from BIS Shrapnel, thinking that the Aussie's about 20% overvalued, and over the next 3 to 4 years it sees it coming back below that 80 US cent level. What's your sort of thinking on that call?
Yeah, I think we've heard numerous calls about the Aussie being overvalued at the moment, but you know, it's really remained quite steady, and perhaps this call is more for sort of the longer term picture for the Australian dollar. Of course, particularly with the unwinding of Western Australia, of course we saw that recent credit rating downgrade for the state, and it does seem like it's a situation whereby we still are enjoying good demand for our bonds, just due to our fairly good credit rating as a country, and at some stage, of course, we are still yielding much better than a lot of these other big economies, but at some stage, once we start seeing a normalization in rates, then perhaps that's when we'll start seeing a bit of an unwind in the Aussie dollar. But for now, it really looks like as long as we're yielding much better than the Eurozone, the US, for example, then we will remain in a fairly good position. But having said that, in the short term, there could be room for a bit of volatility for the Australian dollar. Of course, we've been holding that 93 mark against the greenback for a few weeks now, and today we've got second quarter construction work done, expected to show a contraction of 0.5%, and that's from a rise of 0.3% the previous quarter. This number probably won't cause too much volatility, but then tomorrow we've got the capex number, and of course this will really help shape GDP expectations. Now, of course, out of China, we also have consumer confidence today, and tomorrow we've got industrial profits. So while today we might not see too big a move, I think headed towards the back end of the week, that's when we'll start seeing a bit more volatility in the Aussie against the greenback, and perhaps that's when we might then see it trade away from that 93 mark where it's been sort of holding its ground over the past few weeks.
Just on your opening call then for the Aussie share market today, we've got that great lead from Wall Street in Europe, but on the other hand, iron ore price down, and a lot of companies trading ex-div as well.
Yeah, exactly right. I think the ex-div is probably the bigger thing today. I think it's taking about 13 points out of the market today, with big names such as Telstra trading ex-div. So that always naturally weighs on the market. But with the way global markets have been going, I think investors are very focused on buying the dips in equities. Of course, the materials sector might be a bit of an exception today. Iron ore has dropped to, I think, 88.90, which is the lowest since September 2012. So that's really not looking good for a lot of these materials plays. But gold snapped its losing streak, and that might see some of these precious metals names enjoy a bit of a bounce at the moment. And earnings probably won't help. If we do get any earnings, generally towards the back end of reporting season, they tend to be shockers. And as well, mining services names have been in a very bad place recently. That credit rating downgrade for Western Australia has really been a telling sign of the sort of hardships that the state's going through. And of course, an unwind in some of these stocks is something that's likely to continue in the short term. So perhaps we'll continue to look towards income, particularly the banks and other high yielding stocks there. But for now, it seems like it'll be a relatively flat trade for the Australian market.
All right, Stan, thank you so much for that.
Cheers, Brady.
Stan Shamu there from IG.